Hello traders, the title of the video is how to predict financial markets using Elliott wave theory like God. Alright, so you may say to me, here we are, George again, talking about God. I don't believe in God. You shouldn't be using the name of God. And I will say to you, when I use the word like God, what I meant is that precisely no one can forecast the market or predict the market like God. All we are saying is that if you want to forecast the market or predict the financial market more accurately, precisely, all right, we are using the word like God. So don't get offended because of that word, because you do not believe in God, or because you believe that I shouldn't be using the word God at all. Let's begin our demonstration today, all right, how to predict the financial market using Elliott wave theory like God, all right. So if you go to our website, www.24elliottwaves.com, we talk about the secret, of Elliott wave forecast. You will see on the web, on our, homepage. I don't want to go dwell on that, all right? So there is a video on our homepage about how to forecast the financial market. But today we're going to do a practical demonstration about how to predict the financial market using the Elliott wave theory like God, all right? I need to remind traders that this video is for educational purposes only. It's neither a solicitation nor an offer to buy or sell, Facebook stock or any other, financial instrument. It is for educational purposes only. Now you need to understand that a lot of YouTube creators go through all kind of pressures, all kind of holes. People try to blame a YouTube creator. People are trying to destroy YouTube because YouTube is the most democratic platform in the world right now. People are doing all kind of things to discredit, YouTube creators. So somebody may say, oh, George, oh, your video has made this stock goes down, X%. You are calling people to sell. You are telling people to do this. I do not. I'm teaching traders on this channel how to use the Elliott wave theory. That's it. People have different games that they are playing on the web. That's up to them. I do not have any game. So what we say to traders, apart from a blah, 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 is that we can use the first wave and the second wave, all right, to forecast the financial markets. We can use the first wave, the structure of the first Elliott wave, to forecast the whole motive wave. All right? So, traders that have been following us know that when I use the word forecast, we are talking about expectation, and that expectation may not be fulfilled, and we shouldn't, use our Elliott wave forecast as a magic wand in the financial market. So we forecast the market may do something completely different. It doesn't mean that the forecast is useless. It just means that the market has done something else. Sometimes the market will do exactly what we are expecting, and then everybody's happy. But in order not to use our forecast wrongly, we use a top-down trading method. We go one step at a time. We say, all right, we're expecting it to go up. We give priority to bullish signal above X level. Price goes above it and finds support, we buy. If not, we don't buy. That's the attitude we want to adopt. Instead of just buying and say it will go up, definitely will go up, and the price goes down. And you say, oh, now it goes down. What are you going to do? And people lose money. It's not good. So for Facebook stock, the financial instrument that we are analyzing today is Facebook FB, Foxtrot Bravo. Here it is. If you are still alive, you should know what is Facebook. All right, now it's to make you laugh a bit. So we have what we call irregular first wave. Have you watched that video about the irregular first wave? So Facebook came into the market at this point in time, a few years ago, in 2012, and the market say that was too expensive, around $50, and they push it down to this level, the low or point, to around $18, and from there on, from that $18, it went up. So we talk about the irregular first wave. Check that video. The irregular first wave is usually a complex wave, formed of a 5-manner wave. Very often you see that. So there's the first manner wave, second manner wave, third manner wave, fourth manner wave, fifth manner wave of the first wave. So from here to here, this is our first Elliott wave. So you see now, I'm putting the number, that's the first Elliott wave for the first book stock. Now the reason why I give you the warning at the beginning that this video is for educational purposes only is that because I have a Facebook account and I do not want Facebook to get upset with me or somebody, okay, doing something, getting upset and closing my Facebook account, say, well, who told you to tell traders that we are now in the fifth wave? But that's what I do. I do for Elliott Wave YouTube channel. All right? Teaching. All right. For Elliott Wave, for Facebook, right there. And we are now in the fifth Elliott Wave. So from 2012, Facebook has begun a trend. After that, a pullback. You remember that? We talked about the irregular first wave. Check it out, okay? That irregular first wave is not part of our wave count guidelines, right? So recently I talked about it. So that's why I'm banging on it, okay? We are now in the fifth Elliott wave. Feel free to disagree with my wave count, all right? So now we can use the structure of the first wave to forecast the whole multi-wave. We can use the retracement of the second wave to forecast the corrective wave. This is about a video on our homepage, www.24elliottwaves.com. But I'm going to do things a little bit different today. To them and say, oh, George, that's not what you have done before. Okay. Generally speaking, what we do, if we are forecasting the market using the first and the second wave, okay, the structure, so I'm going to go first for the corrective wave. So if, for instance, choosing my word carefully, for instance, the fifth wave ends somewhere here, up there, okay, and a correction has begun, we want to know how far that correction will pull back. So one of the strategies that we use is to see how far the second wave pulled back in relation to the first wave. So if you look at this just with your eye, you'll see that this is like 38.2% Fibonacci retracement in comparison to this complex first wave. 38.2%. So the first thing that we will expect is that the correction will be a shallow correction, maybe a flat correction, a classic flat correction, or a shallow correction to 38.2% level. But I told you already that I'm going to do things differently today because I do not believe that the correction will be shallow like this. The correction will be something that I want to use instead. So what I want to add today to traders that they can do is that if you have an irregular first wave, all right, instead of using the retracement of the normal second wave, we can also use the retracement of the second manner wave of the irregular first wave or the second manner wave of the complex first wave. Are you getting it now? So I want to dwell on it a bit. A lot of traders already understood it, but what I'm going to do now, what I'm about to say, is for traders who are still trying to understand what I meant by that. So you don't think that I'm repeating myself. I'm doing it on purpose. Okay. So you can drink your tea and forget about me for 2 minutes and come back again, okay? So when we have first wave, second wave, here it is. We use the retracement of the second wave to forecast the corrective phase at the end of the fifth wave. Good. Now, sometime, if the first wave is subdivided into 5 manner wave, You can also use the retracement of the second minor wave or the first wave itself to forecast the corrective wave. So what you need to do is that you want to be aware of the retracement of the normal second wave and also about the retracement of the second minor wave. Use both to have a bit of idea what is likely to take place. This is the scenario here. So looking at this one is like 38.2%. So we say, all right, correction may be shallow. Looking at the second minor wave or the first wave, this is 61.8% Fibonacci retracement of this second minor wave in relation to the first minor wave. So we can use the first minor wave or the first wave and the second minor wave of the first wave to forecast the area wave cycle. Is it clear enough for you? Okay, let's move on. Otherwise, other trader will get upset. Replay the video. Okay, so this is it. So I'm using, instead of the normal second wave, I'm also using the retracement of the second minor wave in relation to the first minor wave or the first wave, because we have a complex first wave, we have an irregular first wave. Here, this is a 61.8% Fibonacci retracement of that second minor wave in relation to the first wave. So I will be expecting the correction if it's beginning. If suppose the fifth wave has ended here, okay, what we will do to forecast the end of the correction or the possible end of the correction, right, does not have to turn around there, but to have a bit of idea what can happen. This is the expectation, okay? We'll apply now the Fibonacci retracement to the whole trend. Suppose, choosing my word carefully, the fifth wave ended here, exactly there on the dot, and you say, hey, George, you forecast the market like God. You see now where I use word. So we will be expecting Facebook stock if, so that 38.2% will be here. If it ends here, it didn't end yet, but if it did, our first forecast for the end of the correction will be somewhere here. If that is the case, if it come to the 38.2% and stop, it come down. If it come down like this, 1, 2, 3, I will be expecting a flat correction instead. So we say a double retracement, 1, 2, 3 up, probably going above this high, creating an expanded flat correction before coming back down to the 61.8% zone, the zone between the 50% and 61.8% Fibonacci retracement. So 1, 2, 3, 1, 2, 3, going back above the high of the fifth wave, pushing the stock a little bit higher before coming down between the zone of $90 and $106 zone, between the 61.8%. The 61.8% is at the $85 zone, and the 50% is in the $106 zone. That's the sweet spot zone. This is the characteristic, in fact, of a bullish cow or bullish financial instrument. Bullish financial instrument, what I call dynamic bullish financial instrument, after a bullish trend, very often those financial instruments we find it very difficult to break below the sweet spot Fibonacci zone, which is the zone between the 50% and the 61.8% level. Therefore, as I'm telling you now, we use the normal second wave to forecast the possible end of the corrective phase if a correction is starting. Looking at the stock, that will be somewhere if it ends. All right, I'm not going to say again if. All right, see here, possibility that we may see another bounce up, creating the B part of the flat correction. I'm not saying that this is what's going to happen. This is one scenario. One scenario can form a flat correction, can form a zigzag, all right, or can form the W, X, Y pattern. Can be a complex correction, or a triangle, a zigzag, a flat, or a combination. But we are trying to predict what may happen. We are not predicting what exactly is going to happen. You may say, George, just tell me. I believe you. You are the man. No, don't think that way in the financial market. It's not about belief. It's about risk control. All right. Okay. So I talk about here 38.2%, 61.8% level. There are more we can do with, now that we have a complex first wave, we can do more with that. Okay. I'm going to do something else. Hold on a second. I want to apply Fibonacci extension to the first minor wave of the first wave. So this is the first minor wave of the first wave, second minor wave, third minor wave of the first wave, fourth minor wave, and the fifth minor wave. Our first wave has ended here, but has been subdivided into 5 minor waves. Now I'm applying Fibonacci extension to the first minor wave of the first wave. Normally, okay, we can apply the Fibonacci extension to the real first wave. This is what we are taught. So I'm putting it there instead of on top of this candlestick bar. I prefer this one because the second candlestick bar is bearish. I put it on top of the high of the bullish candlestick bar. So I brought it there. No big difference, okay? I can work with that. Normally, we apply Fibonacci extension to the first wave, okay? All right. And then we want to check whether we have a regular, you see here, we have a normal third wave or extended third wave. Now we have an extended third wave because it went above the 161.8% Fibonacci retracement. You see all the retest or the 161.8% Fibonacci extension level of the first wave. All right. But you can see that because you see the way the price came down first before going up like this, traders who understand the irregular first wave will understand what is happening here straight away. So we can apply the Fibonacci extension to the first minor wave or the first wave, you see here, and see where did the third minor wave of the first wave has ended in relation to the first wave. So here we can see that the third minor wave of that first wave has ended in a zone of 238.2%, 238.2%. It went up a bit, it went a little bit above it, so it went in a zone of 238.2% Fibonacci extension level of the first minor wave or the first wave. So with that information, as the second wave is completed here, we can forecast the possible end of the third wave itself. So we are using a relationship between the first minor wave and the third minor wave to forecast the real third wave. And with the Fibonacci extension applied to the first minor wave, we know now that the third minor wave has ended in a zone of 238.2% Fibonacci extension level of the first minor wave. So as the second wave is completed here, we'll apply the Fibonacci extension to the first wave itself, and we'll highlight which level? The 238.2% Fibonacci extension level of that normal first wave, expecting our third area wave to end somewhere in that zone before the price even reaches that level. We already draw that level of $145.32 for the Facebook stock because of the structure of the first minor wave in relation to the third minor wave. We are able to forecast the possible end of the real third area wave. So we draw it and we say, so as the second wave is completed here and we see it breaks above, you see how it breaks above the first wave here and retest it going horizontal, start going up, we say that the third wave has a high chance to end here. Look, that's where it ends. It ends in that zone, yes or no? So at that point in time, you may say, George, you did forecast the market like what? God. Precisely. Did not hit that 145.32, but it stopped below that level. Just using the structure of the complex first wave, we are able to forecast a portion or the third wave of the motive wave. Isn't it beautiful to forecast or to predict the financial market using the structure of the first and the second wave? Good. So this is about the third wave. Let's talk about the fourth wave. So for the fourth wave, we're going to apply Fibonacci retracement, not extension, to the third wave, to the third mono wave. Okay, the third mono wave we apply here. Is that correct? Yes. And this is the fourth mono wave. So we are comparing the fourth mono wave to the third mono wave. The retracement is 38.2% level. So with that information, looking at the structure of the internal wave of the first wave, we can forecast that the real fourth wave will be shallow because the fourth mono wave of the first wave is 38.2% retracement of the third mono wave of the first wave. So we will forecast that, okay, when the real fourth wave is underway, there is a high chance, no guarantee, that that fourth wave will also pull back into the zone of 38.2% Fibonacci retracement of the third wave. So remember, the first time we forecast the possible end of the third wave, it was gorgeous. We forecast it like God, it end there. Now the fourth wave is underway. Again, we go into the structure of the first wave, and we say that, okay, because now we know that the third wave, this is likely to be the fourth wave, we apply Fibonacci retracement to that third wave, and we will draw again a line here at 38.2% Fibonacci retracement of that third wave, area wave, and say that the fourth wave has a high chance to stop somewhere in that zone. It couldn't even come there, but it turned around there. Isn't it gorgeous? All right? Couldn't touch it, but it was shallow, quite shallow on this one. Right? If I adjust my line a little bit, like Fibonacci traders adjust the drawing like this, same thing, quite close, you see, near the 38.2% Fibonacci retracement, above it. The fourth wave was very, very shallow. So we will say to trader, the fourth wave is likely to be shallow because the fourth mono wave in relation to the third mono wave is shallow. We are now in the fifth wave. How can we forecast the fifth wave using the structure of the internal waves of the first wave? Remember, we can use the structures of the internal wave of the first wave to forecast the whole multi-wave. So the multi-wave is starting from the low of the first wave to the top of the fifth wave. It's becoming very, very interesting how we can forecast the market using the Elliott wave theory. So forecast or prediction, all right? All right, now what I'm going to do this time, my friend, I'm going to apply Fibonacci extension to the first wave. There are many ways we can forecast the end of the fifth wave, and this is one example here. Applying Fibonacci extension to the first mono wave of the first wave itself, and comparing the end of the fifth mono wave to that first mono wave. So if you look carefully on my chart, you can see that this is the fifth mono wave of our first wave. We're a little bit above the 314% Fibonacci extension level of the first wave. So we can call it 338.2%. So it went a little bit above 314% level. We call it a 327% Fibonacci extension level of the first mono wave of that real first wave. So with that information, we can also predict the possible end of the real fifth wave, because the structure, we are using the structure of the first wave to forecast, okay, the multi-wave. So let's do it now. So I'm applying now the Fibonacci extension. I told you before that I'm putting it here at the high of this bullish candlestick bar instead of this bearish candlestick bar. The difference is not big. You can play with both and see what's happening. Right? Applying Fibonacci extension to the real first wave, and we can forecast now that the real fifth wave has a high chance to go a little bit above the 314%. You see? This is the 314% level. We go a little bit above. We can predict that. The Facebook stock has a high chance to go a little bit above the 314% Fibonacci extension level of the real first wave, even to the 327%. Let's see whether I can bring on my chart. What am I now? That 327, 200 to 38, 261. I need it 200%. Okay, remember that the pink line is a 314% level. I'm going to change the 314 to 327. Okay. All right. This is a practical market prediction using the area wave theory. We are analyzing, forecasting, predicting what is likely to take place for Facebook stock. 327%. Here it is. That's the dotted line here. I call it in black, the black belt. That's it. So high probability that Facebook stock may push it to the $185 zone. When it comes to the zone of $192.66, we need to monitor the reaction of the price carefully here due to what has happened during the formation of the complex first wave here. There is a high chance that the fifth wave may end between those two lines, the black line at 192.66 and the pink line 185.70. So some trader may say, George, you just told me that buy Facebook stock because it will go up to $185 because now it's at 174.49, and you just tell me to buy, it will go to 185.70 level, even to $192.66. Thank you very much, George. You are the man. No. All right. It's an expectation. The price can change direction now and start coming down. You may say, well, you did say to me to empty my saving account and bet my saving on this stock. Now I lost everything. Don't do that. Don't do that. Even if you are drunk, don't do that. Okay? It's a forecast. The price may do exactly what we're expecting. It may not do it. So in order to control the risk, we use a different time frame trading method. We take it one step at a time without gambling, all right? And if the signal fell, we come out. Very simple, okay? So here we are predicting the financial market, in this case, the Facebook stock, using the area wave theory. So as you can see now, I've done things a little bit different today, all right? So this is what is happening when we are talking about practical market prediction. Normally, we say first wave, second wave. We use the structure of the first wave to forecast the multi-wave, or to forecast the third, the fourth, and the fifth wave. This is about the structure. This is a good example here. You see, the structure of the first wave allows us to forecast. So here you can see that the structure of the first wave, the second minor wave of the first wave was 61.8% Fibonacci retracement level of the first minor wave. So that information is helping us also to forecast the real second wave itself, because the first wave is a complex wave. We can use the structure or the retracement of the second minor wave in relation to the first minor wave to forecast the second wave. So here with this information, we'll be saying to traders that we will have a deep retracement, that Facebook, if we are going to have the second wave, it will come down to the 61.8% Fibonacci retracement of the real first wave, but it did not. Here it was a shallow. We are expecting 61.8% retracement for the second wave. It didn't happen. It's only 38.2% level. You see, the expectation and the reality of the market. But using the area wave principle, this is what we will have said to traders as this irregular first wave is completed. We will say that high probability that the second wave will be 61.8% Fibonacci retracement level of that first wave. It did not. It's 38.2% level. All right, it's not an exact sign. But as you can see, as we use the structure of the first wave, we managed to forecast the possible end of the third wave like God. here it is, no big difference. This is gorgeous, isn't it? We were able also to forecast the possible end of the fourth wave. 38.2% expectation was shallower than that. Good. So we will be saying it will be a shallow fourth wave. It was. We are expecting a third wave to stop below the 14532. It was. But here we will be saying to traders that the second wave will be deeper. It wasn't. So what do you do about that? Use a top-down trading method, control the risk, and know that the forecast, the prediction is a prediction. The price can print something out. Don't use it at an exact time. Don't gamble. All right? And so on. So, this is about the structure of the first wave. So, the retracement, this is something completely new I'm doing today. The retracement of the real second wave in relation to the real first wave, that's what we use to forecast. So we will use the structure of the second wave and the retracement of the second wave. So if the second wave is a zigzag or a triangle and so on, we'll expect, okay, the correction to duplicate the structure, the form, and the shape and the retracement of the second wave during the corrective phase, all right, of the Elliott wave cycle. So looking at this, we'll say 38.2% level. We didn't see the zigzag pattern, it just went straight down. So we're saying it will be a straight down move to 38.2% level. With the information that we have here, that's all we can say to traders. But because the first wave has been a complex wave, we can also use the structure, the shape, and the retracement of the second manual wave of the first wave itself to forecast the possible corrective phase. So 61.8% or 38.2% level. Attention to both structure. The second manual wave and the real second wave will help us to forecast, okay, so either 38.2% level. If that is the case, I will be thinking of a flat correction. 1, 2, 3, 1, 2, 3 up, before 1, 2, 3, 4, 5, bringing the price down to the 61.8% Fibonacci retracement level of the whole trend. So you see now, with the first and the second wave, we can forecast the whole multi-wave. We were able to forecast the end of the third wave, the fourth wave. Now we are expecting the fifth wave in normal condition. If the market is fulfilling our expectation, the fifth wave will end somewhere in the zone of, between the 18570 and 19266. We will see. It may not do it, it will do it. While you are looking at here, I also draw a channel. This is what we are saying. All right, using multiple authentication. You are using the Elliott wave theory. It's not the only thing we are using in the market. We use market geometry and trend line and so on. You remember the video that I posted recently? All right, fast moving stock, how to use the Elliott wave to trade fast moving stock. So here on this, you can see clearly that there was this blue channel. Okay, price pop out of it, is retesting the top of the channel. We project in the direction of the price. This is the median line, the orange line here. You see, it's the median line of our new projected channel, which is above the first channel. Right, so we measure the width of the first channel and we project in the direction of the price. And this is the median line of our projected channel. And the intersection between the pink line and the orange line is what? A hot spot trading zone. So you say to me, George, what's that? Subscribe to 24 Stock Trader YouTube channel, even if you are trading currency, commodity, or something else, because we are talking about technical analysis. All right, hot spot trading zone here. All right, so use the market geometry in conjunction with your Elliott wave forecast, Elliott wave pattern to make excellent decision. Give precedence to the price action before the wave stretches. All right. So you see, sometimes we did forecast the market like gold, predict the financial market like gold. Are we going to predict the market here like gold again? Are we going to forecast the corrective wave like gold, or is the price going to print something else out? So as we have the expectation, all right, so especially the corrective wave, you are looking at the structure. There are 4 essential corrective waves: a zigzag, a flat correction, a triangle, or the combination. We talked recently about the WXY pattern, which is a combination of 2 corrective waves and the S wave in the middle. So a corrective wave, you want to look at the structure. Free, 38.2% talking about WXY, all right? Free, 5, flat correction, all right? One step at a time. Minimum price move is free. Draw the channel, break below, retest, project the channel. If you come back below it here, just use it at the same channel. That will help you to pinpoint the possible reversal point. In conjunction with your area wave forecast, you're expecting it to go to 38.2% level. Yes, you are a smart area wave trader, nothing wrong with that. But don't forget to use other technical tools like market projection, okay, market geometry, Fibonacci retracement, and so on, and so on. So you may enter the trade at the right place and also at the right time. You see now? So map it out. Okay, you may say, how do you map up a chart? Then I'll say to you, there is a video right now at the 24 Stock Trader YouTube channel where I'm teaching traders powerful technical, okay, chart analysis. All right. So you see now, so you can project it as many times as you like. Okay, drawing those lines and checking the hotspot trading zone or using what I call recently the fire. One trader said, Joe, you are making us tired because I've posted a video recently, but the trader said, you are making us tired. Okay, I understand. Okay? All right. So coming down 38.2%, 61.8%, watch the hotspot trading zone intersection between the Fibonacci key levels and those okay trend line on your chart. So this will conclude our discussion today about how to predict the financial markets using Elliott wave theory like God. All right. If you are offended because I use the name of God, just remember that I believe in God. All right, like everybody, like many people out there. But some people do not believe in God, so we can't force them to believe in God, can we? All right. So the next thing, when I use the word like God, right, it's just about saying precisely, accurately, on the dot. All right, that would be nice, isn't it? No one can forecast the market exactly all the time, as I show you now. It's just an expectation. The market may do something completely different, and you may wonder what's going on. All right, so we want to go one step at a time, following the price itself, trading on the edge in a hotspot trading zone. And in all cases, we want to use a top-down trading method. One can use the structure of the first wave, especially if you have a complex first wave, to forecast the multi-wave, the retracement of the second wave, the second minor wave of the first wave in relation to the first minor wave, the retracement of the fourth minor wave of the first wave in relation to the third minor wave to forecast the fourth wave, and the relationship between the fifth wave and the first wave. All right. And the relationship between the first minor wave of the first wave and the fifth minor wave of the first wave that will help us to forecast the real fifth wave. We can use also the relationship, okay, between the first wave and the first minor wave of the first wave and the third minor wave of the first wave to forecast the real third wave. We can use, all right, either the second minor wave of the first wave and the real second wave to forecast the corrective phase. All in all, we are using Fibonacci extension, Fibonacci retracement in conjunction with the wave pattern, but the forecast or the prediction is not an exact science, it's just an expectation, and we should not say that definitely this was going to happen. We need to be prepared, be ready to buy, and be ready to sell, even if we are saying that, okay, this stock will pull back. One more thing before we close this video. Now that we are talking about the fifth wave possible end right here, all right, you can see that the fifth minor wave or the first wave is not extended, but anytime we are in the fifth wave or third wave or first wave, the fifth wave can be extended. So don't be surprised if instead of the fifth wave ending right here, it's prolonged more, continue to go up more and more, which means it's extended. Sometime Some stock, because people are buying the stock, so now you see this stock went up in a zone of $14, okay, $14. Today it's at $174. Talking about the values that Facebook is creating and the market share that they are gaining, right? Talking about the strength of their fundamental, their balance sheets, and looking into their future. Do they have a brighter future? And then where is the S&P 500, the market itself, and the sector, that the technology sector, and the market leader that belong to that sector? Okay, anything is possible. The price may continue to go up beyond our forecast of the end of the fifth wave. So if it breaks above the 185 level or the 19266 level and find a support, that's why I say give precedence to the price action. Is there an invitation to buy? If there is, continue to buy. If the signal fell, come out. If there is a bullish signal, take it. If the signal fell, come out. So the expectation is that it will end here. It may not end. The fifth wave can be extended and prolonged. If you have any question or suggestion, put in the comment section. And in due course, I will be recording another video to answer your specific question. If you find this video truly useful, let us know by giving us the thumbs up. If you think that, George, this has been a long blah blah blah, full of nothing, all right, mark it down. That will put that under pressure to improve our next recording. However, if you think this is an essential tutorial, then feel free to share with your friend on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the GSTW24 traders talking about how to predict a financial market using Elliott wave theory like God. Was he like God or something else? Let us know in the comment section. Happy trading to you all, and speak to you soon.